Hey, this is Crystal Miller with another Tip Tuesday for you. Today I wanted to talk to you real briefly about mortgage insurance. I get lots of questions about this, and I feel like there's really easily confusion in regards to what it is and who it protects. So, in a loan, you have mortgage insurance and you have property insurance, completely different things. Property insurance is obviously your traditional perception of insurance, protects your home in case of a damage through storm or something like that. Mortgage insurance actually does not protect you, it protects the investor. So, all loans, most loans, I should say, have some form of mortgage insurance to them. So, if you're doing a VA loan, they have what's called a funding fee, which is basically a version of mortgage insurance. If you're a first time home buyer through VA, and you're putting zero down and you're not exempt from the funding fee, which would be something that you know through your VA benefit package, your funding fee could be 2.15%. Now, that loan can take and finance in the funding fee. You don't have to come to it with cash to the table, but it's basically something you can finance in through your home loan. But that's the VA's version of mortgage insurance that protects them in the case of default, which is basically what mortgage insurance is in the first place. It's protecting the investor in the case that you should default on your loan. So this is money you don't get back or anything like that, but it's something that they put in place after the mortgage meltdown. There's also USDA or RD. They have a 1% upfront fee, and that's basically it comes off the base loan amount, and they don't call it mortgage insurance. They have a different name for it. It's called the guarantee fee. But basically, it's the same exact concept. They're protecting their program based off of previous versions of foreclosures that have come through. So every year they kind of revisit what their foreclosure rates have been and what their overall look of their program is, and that number often adjusts. So it's not uncommon that once a year or every couple of years, USDA will come out and they'll say that their guarantee fee is going to go down, which it has most recently, but it can go up as well if they start to experience a high volume of foreclosures. You've also got FHA. FHA has an upfront mortgage insurance, and that is 1.75% of your base loan amount. Now, FHA is a government program, and your upfront mortgage insurance goes to the U.S. Treasury Department. Those funds go in and protect the government in case you, the borrower, default on your loan. So that's also a fee that you finance in with your loan. It's something that you don't have to come to the table at closing with it as extra out-of-pocket expense. So conventional is kind of the one exception to all these upfront mortgage insurance fees. Conventional does not have an upfront mortgage insurance. They have monthly if you don't put down 20%, but they don't have the upfront fee. So that is one benefit to a conventional loan versus some of these others. The give and the take oftentimes reflects on the interest rate too. Some of the government programs, they have this little bit of an access fee through their mortgage insurance, but their rates oftentimes are more competitive than what your traditional conventional loan is going to be. So it gets a little bit complex the more you dig into it, but that's the really, the most basic kind of explanation, especially on the upfront mortgage insurance part. So there's also monthly mortgage insurance on some of these loans, and we'll talk about that another day. But I just wanted to give you a quick insight as to what mortgage insurance is really all about, and make sure you understand that that is not something that's in place to protect you. That's protecting the investor in the case of a default. So hopefully this is helpful info, and I'll see you next week. Have a great day.